Hi, everyone. This is David Gellner and Parker Ksidakis with the Gellner team of Kidder Matthews. We're hard to believe already done with Q2 of 2024 and wanted to provide a quick market update, go over some topics that we're getting a lot of questions on. Parker?
Yeah, definitely. Well, I think to start, my question to you is overall, how's the market? Do you have any statistics or anything you can kind of share some information on?
Yeah, so in Q2 of this quarter, 2024, we saw 25 retail investment sales in Washington and Oregon. So purely retail investment sales. That's about five more than we saw in Q1 of 2024. Overall, we haven't seen very much or significant movement as far as pricing. Of course, that depends on purchase price, but also single tenant versus multi-tenant, which I think we can get into a little more. But overall, the retail fundamentals remain strong, and we're seeing, while a slower transaction velocity from certainly, 2020, 2019, we're, still at historically strong pricing and retail fundamentals.
Is there a section of that market that's getting the most activity, or is there a pricing or a product type that's
Yeah, there definitely is. I think, as we mentioned in our Q1 report, we're still seeing an overwhelming amount of buyer demand for multi-tenant retail centers. Shopping centers or multi-tenant retail is very much in demand right now, probably the greatest demand we've seen in the last 10 years. And a large driving force behind that is we're seeing a huge amount of first-time buyers enter our retail marketplace, especially focused on multi-tenant. So those groups are coming from the multifamily space primarily, which typically that buyer pool would lead itself towards more of the single-tenant asset class, which is more passive by nature. But really the biggest change we've seen in the last 6 to 12 months has been a lot of these multifamily, historically multifamily owners coming into the multi-tenant retail side. We've also seen a huge influx of demand from other asset categories like gas station owners and operators who want to sell their business in real estate and own something multi-tenant retail oriented. So that's been probably, I would say, 60 to 70% of the buyer pool is these new ownership groups coming into multi-tenant retail for the first time ever because of some of the headwinds they're experiencing in their primarily their portfolios of multifamily or other asset classes.
and you think there's any other driving forces that is making multi-tenant as hot as it is right now?
Yeah, I think a couple things for sure is we're still at 3% vacancy rates in the Puget Sound. So retail fundamentals have never been better. Those are historic low vacancy rates. We're also seeing significant rent growth when lease renewals come up. And then again, like we talked about in Q1, is because of the inflationary pressures we've all experienced the last 2 years, a lot of these this new buyer pool is coming from an asset class that does not have triple net leases. So they've, been having to accept and kind of take the brunt of these operating expenses increasing dramatically, where multi-tenant, as we know, is insulated from that, even single tenant as well, because of the triple net leases that are in place. The operating costs get passed to the tenants, and it's a lot more insulated of an asset class.
And you had mentioned kind of buyer pool a lot, just selling other assets. Do you think that's the driving buyer pool right now? And with the new buyers, are they looking for different things than the historic retail buyers, or are they looking at the same fundamentals?
I think mostly the same fundamentals. What I would say is we're starting to see more apartment sales come through, which typically 60 to 70% of the retail investment properties, especially single tenant that we've sold in the past, has come directly from the multifamily side, looking for that passive investment. I would say the biggest change in this new buyer pool group is they're exiting an asset class that they've typically owned for a long time, and they have a little more aggressive underwriting and requirements for multi-tenant retail in general. So specifically speaking, our average cap rate for a multi-tenant retail center that is sold in the last 2 quarters under 5 million is still right around 6.5 to 7%, which 6.5 to 7% cap rate for a multi-tenant retail center, that's near historic lows. Typically, we have in the last 10 years a multi-tenant retail center, there needed to be at least a point to a point and a half of spread between cap rate and our current interest rate environment, and we're pretty much seeing that neutral right now at 6.5 to 7%. So maybe it's neutral or a half a point higher than our current interest rate environment, which as of today we're starting to see interest rates quotes in the high fives for the first time in a long time. So there's some positive movement there. But most of the quotes have been 6 to 6.5% interest rates.
Interesting. And with the buyer pool in general and coming into retail, we used to see, we've always kind of looked at it as the I-5 corridor, Washington and Oregon, and then secondary and tertiary markets typically on the east side of those states. A lot of the times those, or at least over the past 5 years, the spread between those was shrinking. Do you think that's still happening? Is it expanding? How would you compare the two markets now?
That's a great point. So I guess one of the bigger changes we are experiencing right now is we're starting to see more of a reversion back to normal historical investment fundamentals. So specifically on geography. So we typically, 5-10 years back, the I-5 corridor, or let's just say the Puget Sound region versus Eastern Washington, we would typically see for apples to apples. So whether it's a Starbucks in Seattle versus one in Yakima, Washington, we would typically see a quarter to half a point of cap rate difference. So obviously the one in Yakima would require a higher cap rate to get sold than one closer to the core. And so the last 5 years, we basically saw everything come back to same comparison. So a 5 cap Starbucks in Seattle, you were getting a 5 cap in Eastern Washington, and the same pretty much applied for shopping centers as well, where there wasn't too much movement depending on geography and location. Well, today, I think we can say pretty definitively, we are starting to see, I would say, 80 to 90% of the buyer pool is really concentrated in major metropolitan markets. So I-5 corridor or the bigger cities like the Tri-Cities region or Spokane, of course. We're not seeing a lot of change there, but specifically in the towns, let's call it 10,000 population or less, we have seen a decrease in the buyer pool. And then those buyers that are interested in those markets, they want to be compensated, 50 to 100 basis points over for an asset out there versus where it would be, closer to the core.
And earlier you had mentioned vacancy rate. It's at 3%. Been a lot of news recently with Big Lots, Walgreens, Rite Aid, Mod Pizza. How do you think, let's go to the bigger boxes first, the Walgreens and the Big Lots. How do you think that's going to affect markets that have those tenants in them?
Yeah, I think that's such an important topic right now, especially for where we're at in the year, compared to Q1 or Q4. There's definitely starting to be percolations of retail fundamental softness, or specifically towards certain tenants. So we've had news come out in the last 30, 60 days with, let's start with Walgreens, the article that they may close up to 25 stores or 25% of their stores nationwide. We still have the Rite Aid bankruptcy working its way through. Big Lots came out less than 2 or 3 weeks ago saying they're going to close a dozen plus stores alone in Washington State. And so specifically for the medium and big box segment, we are starting to see, whether it's right now, but definitely leading or indicating towards the future, we're going to see some vacancy there. And I think the two most important things to convey, if you own an asset class like a Rite Aid or a Walgreens or a medium or big box, and you hear the news on a potential tenant having issues, we highly, highly suggest that you definitely either reach out to us or reach out to your leasing broker or expert to get out in front of these issues or potential issues and at least know your options, know potential backfill rent, if the worst case scenario does happen, and then also know the costs associated with that so that you're prepared and at least have a plan or an idea of a plan in place for if the tenant does give notice that they're closing down a store or vacating.
And big topic on everybody's minds, inflation, especially with recent news of McDonald's and Starbucks sales declining by 1%. Do you think that's indicative of a larger market dynamic, or do you think we're going to see that across other tenants, and how will that affect owners?
Yeah, so like the news came out this week of Starbucks and McDonald's having their first sales decline since I believe it was 2020. If you take that information and look at consumer spending data, it does appear the consumer is slowing down spending wise, especially with credit card balances continuing to climb. So it does seem like the consumer is definitely spending less. And so what we would say is, something to watch. So everyone's been talking about, hey, the vacancy rates are so low, the fundamentals are still extremely strong, but there are, clouds on the horizon, so to speak, that, really, if we're getting a lot of inquiries from potential people who are looking at selling their assets and trying to time the market, looking mainly at interest rates. But I think the next topic that should be on the front of everyone's mind is, hey, retail, there's some clouds out there that would indicate that retail and consumer spending is slowing down. So it's something definitely to be aware of.
And with owners, you had mentioned, we've gotten a lot of inquiries recently, within our team, or, just within kind of the broader picture. What are you seeing with, BOV activity? Do you think sales are going to increase in the later part of this year as a whole? And what's your crystal ball say?
Yeah, it's always tough to have a true clear picture in an election year. Obviously, a lot of election conversations. I think we just get down to the fundamentals. Our team, the Gellner team at Kidder Matthews, we've done in Q2 more broker opinions of values and underwriting as a team than we have ever done in probably the last 10 years. So that would indicate from our conversations and that activity that a lot of folks are considering a future sale, whether it's the latter part of this year, Q3, Q4, or early next year. I think the bigger topic of conversation or just a broader market perspective is, in these broker opinion and values, or when we meet with our clients, we're the pricing is pretty close or near almost essentially 2019 to 2020, right before COVID hit. And so I think it's important for us to look at, if our 10-year treasury as of today is at 4.15%, in 2019 to right before COVID came out in 2020, the treasury rate was, 2% or below 2%. And so the feedback, if we go back a year, has always been, hey, I'll definitely consider selling or want to sell when interest rates come down. But really, in our opinion, even let's call it if the treasury goes from 4.15 to 3.15, that's still higher than it was in 2019, 2020. So we really don't know. And our expectation is, I think it'll drive a lot of transaction volume, but not necessarily because it'll affect pricing as much as the main bottleneck, or the feedback we've received from our clients is, hey, we love your pricing. This is great pricing for the asset we want to sell. The big bottleneck is, hey, if we take those proceeds and have to go into a new asset, we're going to take on 6% debt. And so our cash flow may lower, or it's just not, we can't get the leverage that we ideally want going into that new asset. And that's been basically why we've seen volume, decrease from the peak of, 2020 to 2022. We're still at transaction volume of, 70% off, or 70% decline from the peak. And so that's what I think is really, driving the market velocity slowdown, because there is still so much liquidity in the marketplace. And there's, from our activity, again, a lot of people who are considering selling. It's really just that bottleneck of, hey, if we sell and get this number that you're telling us, we have to go in and take on higher debt costs, which is really creating a lot of the slowdown.
So you think that's the main, driving factor right now of why we're at 25 transactions compared to 50 is folks don't want to have to recast their debt if they've got 1, 2, 3 years remaining. They're going to wait and decide what to do then.
Absolutely. Yeah, I think folks are saying, hey, specifically, I like this number you've proposed. Sounds good to us, but when we compare what's on the market, because we are still seeing limited, retail investment opportunities in the Northwest for a couple reasons, which maybe we'll segment right now to, what's creating the slowdown or the limited retail investment opportunities on the market. Well, we've basically seen new construction retail grind to a halt the last, call it 20 to 24 months. Construction costs have gotten so high along with debt costs, so those directly affect the developer. Retail tenants are paying, record high rents for these new locations, but still even at those record high rents, cap rates have gone up for single tenants, specifically 25 to 50% on average, obviously depending on the asset type and the tenant type. So we're still seeing very little inventory on the market, and we have this pool of investor liquidity that is waiting for opportunities.
What or where do you think value is out there hidden, in plain sight, where it would be so valuable that somebody would be willing to recast debt to 1031 to do a great deal now? Like, where do you think those great deals are going to come from?
Yeah, I mean, we get a lot of calls, obviously, value add buyers, or they want some quote unquote meat on the bone, so to speak, for their opportunities that they acquire. I think the big change, if you look from 5 to 10 years ago to now, is we have 3% vacancy rates in Washington State, basically. And so the value add historically has been, hey, find me an asset with some current vacancy. So an opportunity where it may be 70 to 80% occupied. And then, you can go and easily fill the remaining spaces and get the lift that way. We're not seeing that type of value add opportunity today, right? Because everything's pretty much fully occupied or close to it. Where we are seeing considerable value is, call it a stabilized retail center that has been owned by the same individual or investment group for the last 10, 15, 20 years, where a lot of these lease rates, especially for shop tenants, are easily 25, sometimes even 50% below market if for a new owner to come in, buy these asset types with these low rents, and then start either negotiating and raising rents with these tenants and be prepared to turn over some tenants and offer some tenant improvement monies. So that's really the straight, value add we're seeing today that looks a lot different than the normalized, historical value add. The other value add we're seeing is kind of what you mentioned beforehand, is we're seeing a lot of these medium or big box tenants that, have some storm clouds, whether it's Rite Aids or Walgreens or Big Lots, or even just medium and big boxes. A lot of these rents are still, especially if they were done 5 to 10 years ago, are in the single digits, right? For these box rents where, we're seeing on average, obviously dependent on market, but low to mid teens for box rents, even on as is deals. So there's some lift there if you're willing to take on the additional risk and time frame of, going through and backfilling those rents or backfilling those tenants in those spaces.
Okay. And with, we were talking about this earlier this week and last week of, perception versus reality. Where do you think kind of the number one spot is, or the top couple where perception and reality right now are differing, with all the doom and gloom in the news and turmoil everywhere? Where do you think, those are super far off?
Yeah, I mean, it's always concerning to see, and this is part of a normal cycle, but the consumer spending decrease, some retail tenant bankruptcies happening, or potentially on the horizon with Mod Pizza and Big Lots specifically. Mod Pizza just did their business buyout, so hopefully that prevented a larger scale bankruptcy. But I think overall the important message, or something to kind of look at when we're considering, the current market of, hey, there's some vacancy or potential bankruptcy is just the fact that if you look at multi-tenant shopping centers specifically, think of the last, 20, 30, 40,000 square foot shopping center that was built in Washington
Yeah.
State. Shopping center
Mm-hmm.
with shop space, so call it, no greater than 5,000 square feet or less. There really hasn't been. There's
Mm-hmm.
been so little construction in our market, and that's not changing. Development has become a trickle of what it was because of those items we mentioned. So really, there's still an overwhelming amount of tenant demand and new tenant demand that will foreseeably backfill
Mm-hmm.
almost immediately or very quickly a lot of these vacancies. Um, and it just comes down to supply and demand for retail specifically. There's still very little vacancy, and there's no new construction putting pressure on
Mm-hmm.
the product that's already in the market.
Mm-hmm. What have I missed? What other, larger trends are you seeing out there?
I think, if we touch on a couple of our most recent sales, so
Mm-hmm.
like just to give hard data and hard real transactions that have happened, we sold this week the O'Reillys in the Burlington,
Mm-hmm.
Washington area. We looked at where we were selling the same new construction O'Reillys, same lease terms and everything. We in 2022 we sold identical O'Reilly's at a 5% cap rate.
Mm-hmm.
And the cap rate today on that O'Reilly's in Burlington was a 5.9% cap rate.
Mm-hmm.
And so we've seen almost 100 basis points of movement upwards for the same asset, same quality construction asset. And so I think, looking at that, I personally view that as a huge value because you basically bought it for what it costs to construct, or even less than it costs to
Mm-hmm.
construct some of those assets. So you're basically buying less than construction at or less than construction costs, which is a great place to be, I would think. And then we sold a couple weeks ago, your Prineville shopping center in Prineville, Oregon, five
Mm-hmm.
tenants, right?
Mm-hmm.
And multi-tenant shopping center that sold at $3.5 million and a 6.25% cap rate
Mm-hmm.
for a multi-tenant shopping center in a tertiary market.
Mm-hmm.
I mean, that's got to be close or definitely at peak pricing, and that is just some very real data points to, especially on the multi-tenant side. It's a really good time to sell, especially $5 to $6 million and under
Mm-hmm.
multi-tenant shopping centers, because we're seeing, again, majority of buyer demand and peak pricing in that
Mm-hmm.
that range.
And kind of piggybacking on peak pricing, how would you compare the market right now to a past market of 2019, or is there a year that kind of, or a time frame that
Yeah,
sticks
I,
out?
th- I think we're right in line with 2019 and 2020 prior to the COVID outbreak, where, you know,
Yeah.
when COVID came out, they dropped the 10-year treasury was under, 1 point. I think it was at like 0.75, where today we're at 4.15. So it's pretty incredible. I think the overall theme is, hey, interest rates really, the main impact of interest rates we're seeing on pricing really is focused on the 6 million and above range. We're still seeing, transaction volume down in the 6 million and above
Mm-hmm.
range, but by 80 to 90%. And that's because a lot of those buyers are, they need to meet cash on cash
Mm-hmm.
requirements. But for 6 million and below, we've seen, on average, multi-tenant, maybe cap rates are up from peak pricing a quarter to half a point, and then single tenant cap rates have moved 50 to 75 basis points, depending on what it is from
Mm-hmm.
true peak. So we're right in line
Yeah.
with 2019 and 2020 prior to COVID. And so I think, to piggyback off of that, some things, if you're an ownership group who's considering selling or just wants to position their assets towards the future, two things that we would highly suggest looking at, depending on that single tenant or multi-asset class that you own, is specifically rental increases,
Mm-hmm.
right? So today you want to have rental increases of ideally a minimum of 2% annual or 10% every 5 years, and ideally 3% annual or 15% every 5 years. I think that's a big focal
Mm-hmm.
point of investors they're looking at, hey, what are the built-in rental increases? So during the peak years, we were selling and seeing a lot of renewals and assets with rental increases. It's hard to imagine of 6 to 8% every 5 years, right?
Yeah.
Well, that's a below market, rental increase for sure right now, especially with the inflationary pressure we've seen. So you really, paint with broad strokes, you really want to have rental increases of 10% minimum every 5 years or higher. If you have below, we are seeing pushback from buyers and investors. The other thing we would highly suggest looking at when your leases come up for renewal, especially single tenant, this seems to be more prevalent with the corporate tenants, is really looking at that CAM language or real estate language for reimbursements of the tenants. We're seeing, historically, a lot of these tenants have had caps, let's just say of 2 or 3% annual, where if the CAMs go up more than that, then there's some potential leakage, especially on the property tax reassessment. So you really, if you're coming up for renewals and likelihood you're going to be on a below market rent, not only focus on, hey, what's a market or higher rent, but just as important, checking your lease and making sure that CAM language and real estate reimbursement language is in there to where you're not coming up to any CAM caps that could, create leakage or just pure buyer pushback for sure.
Interesting. With Washington and Oregon as a whole, I know I've got a lot of clients, you've got a lot of clients looking to 1031 out of the state. Do you think that's a small trend? Do you think that's going to continue to happen? And do you think, are we still seeing investors from out of state, California, wherever it may be, coming into Washington and Oregon?
Yeah, I mean, broadly speaking, I think we're seeing a trend, which we hear all the time, especially in Oregon because of the sales tax, being, or the income tax, and then, Washington State not having an income tax. So we're continuing to see, investor groups come into Washington State specifically. I think we're seeing as part of that trend on location, just in Washington State, primary markets or suburban markets versus tertiary. We are starting to see a trend where if we compare or ask the Starbucks in Washington versus Oregon, or even assets and multi-tenant assets in Oregon versus Washington State, because of that state being, a grade or two below, obviously on business friendly, a Texas or a Washington, the longer term trend is investors want to be where they're treated best and where the environment is friendly, right? I mean, that's not Earth. It's been like that, but because things have changed in our states and become, frankly, less business friendly, we are not seeing the amount of capital, flow, while it is still there, certainly from leaving an environment like a California to Washington. Washington is still considered much friendlier, but we have seen this overall theme where investors are now targeting, more of the mountain states like the Idahos and the Montanas of the world. Of course, Texas, with no income tax and then being extremely business friendly. So I think that's a trend to continue to watch. I would say, the thing that insulates even in especially in Washington, but even in Oregon, is it is, insulated in a lot of regards because it is so difficult to construct new product there. So it does create, it's kind of a push and pull. Yeah. It does create a lot of insulation, but really overarching, and if any, politicians or anyone's listening, investors, especially in this day and age, it has never been an easier environment to migrate your capital to other states, right? With the internet and everything being online now. So we really want to come back and really advocate for Washington should be, for the foreseeable future, a business friendly state. And we really want to advocate for that. I mean, a big pushback that we've seen from investors, especially on the larger asset class or larger price point, is the excise tax, right? So they may have bought these $10 million, $15 million assets in 2020, 2015. Well, a huge thing to be aware of now is the excise tax, the seller excise tax, how that's gone. What is it, $3 million and above on purchase price? You're now getting taxed 3% on anything above $3 million. So we've heard and had a lot of feedback on those larger assets that we've sold that have frankly surprised a lot of groups because 3% on a 7, 8, $10 million sale, it's a lot,
Mm-hmm.
right? Because that's coming straight off of whatever you net. So
Mm-hmm.
Washington is still deemed, from a 50 state, looking at a lens of a 50 state of, hey, we're still a business friendly state, but we really, really want to see, the political environment and the state environment not come down with any additional taxes or business regulations because that Washington State is primed to be a great place to invest with the no income tax, right?
Mm-hmm.
That's been a huge driver, but we just really want to see a business friendly environment
Mm-hmm.
in the
Definitely.
future.
It's interesting because it's kind of the double-edged sword. It seems like where it's really difficult at some points. Excise tax is a prime example, but also because it's so difficult to build, to do TIs, get permits, whatever it is, it seems to be keeping our vacancy low. Is that
Absolutely.
part of the push and pull
Yeah,
of it?
absolutely.
Mm-hmm.
I mean, you can't, it's very difficult to build. That's
Yeah.
why we have a 3%, vacancy rate across Washington State. So
Mm-hmm.
Washington State, we still believe is a great place to invest, and even the Northwest in general, just because we are still seeing, we have great economic drivers in our states. And again, a lot of these longtime retail assets are so insulated because there's nowhere for these tenants to go.
Mm-hmm.
And so it's retail is still fundamentally
Yeah.
very strong, even though there's some storm clouds on the horizon.
Mm-hmm.
So, what we would end this market report on is, if you're listening or have any questions specifically, dependent on your asset or looking at potentially buying, please reach out. We're available to offer help behind the scenes or any extra data from our market report. So please reach out to David or Parker and the rest of our team if you have any additional questions on this report.
Thank you.
Thanks, Parker.